All right. Welcome, everybody. Thank you so much for coming to Fundraising 101 with David S. Rose. He has promised that this is going to be the most jam-packed presentation he has ever done for us, so I will not belabor the intro. I will let you all know, if you have questions, please plop them in the Q&A or chat. We will feed them to David during the presentation. We will also have Q&A after the fact, and we will be recording this and sending it out after the fact for everybody who RSVP'd. It will probably take us a couple days, but it will get to you. With that said, David, the floor is all yours.
Good afternoon. Hello, everybody. For those who I have not had the pleasure of interacting before, let me give you 2 minutes of background on myself so you know who I am and where I'm coming from. I am a fifth-generation serial entrepreneur. This is actually a photo that I dug up a few weeks ago showing me at about age 16 in my high school, where I created an after-school film program.
David, your screen is not currently shared.
My screen is not currently shared. Well, hold on a second. We got to share the screen. And I will start. Actually, let me just start back up 1 second. That was my bad. Hold on. All right, let me share this. How about that? Nope, still not doing it. Okay. 1 second. We're going to restart this in just a sec. Hold on.
Cool. All right, it's giving people more time to filter in.
There we go.
There we go.
This was carefully designed to give everybody else a chance to come on into the room over here. Okay, so good afternoon, everybody. My name is David S. Rose. I am the founder and chairman of Gust, and we're going to be talking today about Fundraising 101. And it's always helpful when you hear a presentation like this to know whereof your presenter is coming from. So my background is I am a fifth-generation serial entrepreneur. So I have been starting companies since I was about 10 years old. This was me about age 15 or 16 when I started an after-school film program in my high school. And so there aren't a whole lot of fifth-generation entrepreneurs around, but what makes me even a little unusual is that I'm also a third-generation active angel investor. My late great-uncle, after whom I was named, was the angel investor behind the portable kidney dialysis unit, vascular stapling, hyperbaric operating chambers, all kinds of things like that. He invented through-the-wall air conditioning, and so on. And for my own contribution to this lineage, I'm currently a VC. I'm a founding general partner of True Global Ventures and a founder of Rose Tech Ventures. And so on top of that, as a founder, I founded Gust, which I am the chairman, executive chairman. I'm the founder of New York Angels, one of the world's largest and most active angel investment groups. Did about 25 million in seed stage funding last year. My current gig as an entrepreneur is I'm the founder and CEO of the U.S. real estate market, creating a stock exchange ultimately for institutional investment in real estate. And for those of you who have recently started thinking about the future, given ChatGPT and things of that ilk and AI, I'm an associate founder of Singularity University and SU's founding track chair for finance, entrepreneurship, and economics, about how the future of technology is changing society. So in the process of doing all that, I've invested in probably 120 companies in my portfolio. I was the first investor and chairman of the board of Comixology, which eventually was acquired by Amazon. I was the first investor and chairman of a company called Panjiva, acquired by S&P Global. I was the first investor and chairman of the board of Jump Bikes, that was acquired by Uber to become the back end of Uber Bikes. So I've got a lot of experience on all sides of the table. And what we're going to do today in the next 55 minutes is to give you a consolidated, detailed, comprehensive view that I've developed over the years, from both raising tons and tons of money for my own ventures, investing tons and tons of money in my own portfolio companies, and helping review companies and see what they're doing. Along the way, since I've got a big mouth, I've written a couple of books. In fact, 2 New York Times bestsellers. The first is the standard textbook on how to be an angel investor, called Angel Investing. And then after a couple of years, my publisher came to me and said, wait a minute, we just realized there are not enough angel investors in the world to make a book a New York Times bestseller. So we went to see who it was who was buying this book, and found it was founders who were buying it to see what the angels were thinking. And they asked if I would write another book for founders, cutting out the middleman and just saying, here's how you do a company and raise money. And so I did. That's what the startup checklist is all about. And so we're doing a subset of that this afternoon as our topic. So let me start out with a place that you wouldn't expect me to do. And that is, what does it mean to start a company, and what is the path to success? And there is one big honking problem, which is that nobody gets it right. Everybody, founders and many investors and governments and and writers will tell you that there's obviously one path to success. You have a great idea, and then you start the company, and at the end of the day, you end up with Apple Computer. You're the world's most expensive, valuable company over here, and the only question is where you fall off this path. Okay, if you didn't get to be the world's richest, trillion-dollar company over there, did you at least make it to an IPO? Well, okay, you didn't make it to an IPO. Did you at least make it to unicorn status, worth over $1 billion? Well, okay, maybe you didn't make it to a public unicorn, but maybe you were acquired by somebody. Oh, you weren't acquired by somebody? Well, at least were you successful enough to put the venture capital badge on your jacket and raise venture capital? No, you didn't do that. Well, how about angel investment? Did you get an angel investor over there for your company? Oh, no. Well, did you at least get a seed investment from somebody? All of these are taken as signs of success, and the only way is where you fell off on this path. And you know what? That is wrong, because it's not that there's one path for success. There are actually two very, very different paths for success. And before you can go out and talk about fundraising, you have to understand very clearly which path you're on and then follow where that path leads, because they lead in completely diametrically opposite directions. So there are two types of businesses. One type of business, which accounts for a large proportion of all of the companies that are founded in the US, is that of the small independent business. And this is the vast majority of companies you see and interact with on a day-to-day basis. The other kind of company is the high growth startup. And my guess is many of you here probably think you're high growth startups or would like to be high growth startups. But in reality, 90% of all businesses that are started in the US are these small independent businesses, wonderful businesses. They're the backbone of our economy. They make a lot of money. They support lots of families, compared to the 10% of companies, if that are these nominal high growth startups that often don't do all that well. They're sort of go to the moon or go home. And so before you figure out how you raise funds, let's look at what the characteristics are of each of these businesses and then figure out where you are, and then we can figure out how you start your fundraising. So to start with, as a small independent business owner, you are likely going to be a solo founder. Nothing wrong with being a solo founder. Most of the founders in America are solo founders. Typically, these independent businesses will operate from one physical location: a hardware store, a design studio, a coffee shop, something like that. They typically are relatively small, so you're likely to have fewer than 10 employees. And these 10 employees will basically be salaried people. They will come on salary. They'll be hourly workers, and they generally will not have equity, an ownership interest in your business. When's the last time you think that the Dunkin' Donuts person or the hardware store counter person has equity in the business? They typically don't. But the nice thing about these businesses, which are doing an immediate thing, serving an immediate population, is they quickly start generating revenue. And because they start generating revenue, you can often go out to the bank and get a bank loan backed up by you personally, an SBA loan, for example, to help this business go, because it's going to be a more of a sure thing. Typically, these businesses can make money, they can do very well, but their revenues will typically be under $1 million annually or so. They can get to there relatively quickly, but then they don't grow too much after that, but they are steady businesses finally. And then this job running this company will support you and your family with a great living and let you get a nest egg. And then at the end of the day, you're typically not planning to exit this business. If you are still running and managing this business when you get to a ripe old age, you might pass it on to your children. You might find another operator who would come and acquire it from you. But you're not thinking about an exit. You're thinking about growing and maintaining a business. All of this is in stark contrast to the other type of business, and that is the scalable high growth business. Now here, you will typically have a co-founder. You don't have to, but Paul Graham, who founded both Y Combinator and OpenAI, has said he only invests in businesses that have co-founders, a hustler and a hacker. So whether yours is or is not, most of these businesses typically have one or more, two or more co-founders. They will typically grow relatively quickly to a size where you will have more than 10 employees. And because these are very risky businesses and they are not making money up front, people have to be incentivized to leave what they're doing and join this crazy risky business. And so therefore, all of your employees will have equity, typically in these businesses, down to the receptionist or the customer support person. Equity in ownership of the company is the standard thing over here. here. And typically, because these might be, something that will take a bit of time to get going, to become profitable, they will grow rapidly and they will need outside cash. These typically will require some type of outside financing because most people are not able to finance these kinds of businesses by themselves. But the reason that you can get outside financing is because you're thinking big, very, very big. These are the kinds of companies. You're thinking Apple. This is the branch where you're trying to be Apple Computer over here. And you're thinking global, because today in the era of the internet and borders, this is a global world. Anything you're doing, whether you can sell, whether you buy, your company, your productivity, your factories, your employees, your customers, your advisors, your customer support operation may well be overseas. And these are always growing businesses. This is like a shark in water. You got to swim forward to get water going over your gills, or else you'll die. So you are focusing on growing this company, and the focus is on the company. It's not your job. You may be the founding CEO of this company, but if it turns out, even quickly turns out, like by the time you talk to your first investor, that you are not the right person to run this company, you better be prepared to leave the company and go recruit a CEO to run the company for you, who is better for the company, because you understand that your fortunes are tied up with the company, not your job. And because of that, the way you get these people to come in and join your company and work for equity and bring in a CEO if you have to and get investors is you are aiming for an exit for day one. You are therefore thinking about, okay, when and how is this going to be sold, right? It could be sold to the public through an IPO. It could be sold to an acquirer for hundreds of millions of dollars. But you are thinking now, as opposed to the small independent business, as to where you get off the train over here. And so, as you can see, looking at these two equally viable, equally wonderful sets of businesses, these are literally apples and oranges. So let's think back what that means in terms of financing for each of these two businesses. So let's talk first about the small independent business, the typical 90% of American businesses, right? Because the amount needed to get these businesses started is relatively modest, right? And because the business itself will get going to get to revenue and profitability pretty quickly once you get it started. I mean, a coffee shop starts making money the very time it sells its first cup of coffee, right? But because it's not this massive, great, giant Apple computer, you're not going to be able to find outside investors. So therefore, the financing risk and responsibility is on your own shoulders as the person who's starting this. So therefore, put those into a pod. And what does that mean? That means that, okay, the funding sources that you're likely to find for these kinds of things are friends and family, because this is often a family-run business. You are supporting your family. They have faith in you. They can tangibly see what you're doing. And so literally the majority of these things that are not funded by you yourself are funded by friends and family. You often can get a bank loan for this kind of business because you can show them your business plan and your business model, and you can show them your customers once you get started. And there are a lot of comparables to go to what other restaurants or hardware stores or design studios are doing. And provided that you are willing to sign for it yourself and guarantee the loan, which is required for any loans like this, you can often get an SBA guaranteed bank loan. So the bank will require you to sign for it, but typically you're not rolling in money, so that will not be the source of a lot of capital that will make the bank feel comfortable. But the SBA, the Small Business Administration, believes in supporting small businesses, and so therefore, if the business makes sense as a business, and if you were willing to guarantee it personally to the bank, the SBA will step in and tell the bank that they will guarantee it alongside of you, and so that will mean that many of these businesses are funded using SBA loans. Other sources for these are credit unions, small regional local things which are designed for their depositors and their community to help them and help develop businesses in the community. There are often grants you can get for small businesses from cities, from states, from regional things who are looking to help build the economy of their area by supporting these kinds of businesses. Then there's something called rewards-based crowdfunding. So rewards-based crowdfunding, this is Kickstarter and Indiegogo, where you can actually, if you have a really cool product and you can get to a prototype by yourself, you can often get somebody to come in and effectively pre-order for what you're doing. The other kind of crowdfunding is equity crowdfunding, and this is where you sell a piece of your company to other people. And typically this is going to be to people who are your customers, your fans, your friends, and equity-based crowdfunding through a standard online platform makes it all legal and provides a way for them to invest in your company. So that's what the fundraising universe looks like if you are the 90% of companies in the country that are these small independent businesses. But what if you're not? What if you are taking that Apple or Amazon or Uber path and you are looking to become the world's biggest whatever? Well, in that case, the calculus is really quite different because the fundamentals are different, right? You need a relatively significant amount of money, not something your friends or family can do, not something you can get by selling one of your products ahead of time, because often these take a lot of investment in coding, in infrastructure, in staff, and other things before you get started. The business will often start by losing money. And so that means somebody's defeated before it's making any money. And because you can't do it out of your own pocket, and because the SBA won't guarantee it, a moonshot thing which doesn't have existing revenue sources here, then you're looking at other people to bear the financing risk here. So what does that mean? Well, it means because this path to the super duper scalable high growth business requires other people to risk large amounts of their fungible cash on a money-losing business. As you might imagine, this is actually a very, very, very tough thing to do. And so despite what you see in all the papers and blogs and everything else, raising money for a startup is a very challenging venture. Forget all these things you see about somebody dropping out of high school and setting up a web page, and the next thing you know, they get $1 billion from rich people doing it. That doesn't happen. I mean, it would be wonderful to think for all of us that we have a great entrepreneur, we just have a wonderful idea, and then we go to the backyard to the money tree and just pull it off and fund our business. But no, unfortunately, there is no money tree. That's not the way it works. You're going to have to now go to other people to find funding. And that's what today is all about. And so now, in terms of getting money from other people, from investors and other sources other than yourself, I have my very first big piece of advice over here, which is don't take my money. If there's any way you can avoid not taking investor money, then you should do so. And I say that as an investor who would love to invest in really cool products, properties and projects and companies, right? Because there are all kinds of wonderful advantages that stem from having total ownership of your company, right? And so not only do you own more of the good things when they happen, not only do you have more control, not only do you have more optionality, not only are you not encumbered for somebody else, if you can bootstrap, bootstrapping is absolutely best, right? And bootstrapping means getting your business to effectively pay for itself. There's a really cool book written by a friend of mine, published by the same publisher, called The Customer Funded Business, which is a great way to learn about how you can bootstrap businesses. And so some of the things that he mentions in the book and describes are how you come up with business models that are pay in advance. So for example, a crowdfunding where you have a prototype and then people pay you money to order your product before you do it, and you use their money to pay for it. Matchmaker platforms where you bring people together and get a piece of whatever they create without spending a lot of money yourself. Subscription models where people subscribe in advance for this kind of thing, and then you use the money from the subscriptions to pay for the thing you're delivering them. Things where you are creating a service and then ultimately you are making money from the service creation, and you can turn that over time because you understand what's going on. You can turn that into an ongoing product-based business. So if you can possibly do it, don't think of angel investments or VC money as a badge of honor. It's not. It's just another way to put yourself into, financial jail with somebody else. So if you can, bootstrap yourself. Okay. Well, how about what happens next? Let's say you can't bootstrap it because it's a really sketchy, risky kind of thing. So what do you do? Well, it turns out there is actually some free money. I said there was no money tree. There is one source of free money, and that's what's known as a grant, a government grant, where the government gives you money with pretty much no strings attached to do it. And America has something in the U.S., and there are similar programs in other countries, but the U.S. is the biggest one. It's called the SBIR STTR program, which stands for Small Business Innovation Research, which is a program of the SBA, the U.S. Small Business Administration, fund that they have cleverly named America's Seed Fund. And so basically Congress passed a law that requires any US government agency that does more than X billions of dollars in contracts every year to devote a teeny part of that to giving money to entrepreneurs to create businesses that are not currently economically viable, but that might help the common good. And so therefore you've got to, and there are 17 agencies that do this, so you can check the SBA's website over here for SBIR. But essentially everybody from NASA to the National Science Foundation to the military to the Department of Agriculture all have these SBIR programs where if you have something that what you're doing is new and you're developing something interesting and it's new and it fits in with their things, creating more food, making distribution more available, helping create things for the, the space station, whatever, you can apply for these grants. It's not a fast process. They do these quarterly, so it typically is going to be, 6 months plus or minus by the time you actually get the money. But there are some pieces of good news here, right? One of which is there are 3 phases to the program. The first phase, you can get up to $100,000, no strings attached, to fund your proposal. If you deliver what you say you're going to deliver and they like it. The second phase can be up to $750,000. Again, no strings attached. So that can be really useful as well. And the third piece of good news is that if you happen to be doing something that fits in with what they're looking for, the odds are much better than angel or venture funding. It's actually about 1 in 4. It's about 25%. So you have to be careful to figure out that you are what they're looking for. But if you do qualify, I would strongly suggest you try for it because it can't hurt and you might get some free money. Okay. So that's the beginning and end of free money. So if you can't bootstrap it and you can't get free money, then what? Then where do you go? Well, who's got money? Well, we said banks have money, right? And so when you go to money and you say, hey, bank, I've got this great company that's coming out here and please loan me money and I'll pay you back when we get to be Apple Computer and you'll get this great interest on your money. And what do you think a banker says when you ask him to fund your wonderful new startup? Right. Banks do not fund startups. A bank might be happy to give you a loan, but only if you sign on the dotted line to personally guarantee it and put up as collateral your house and your car and your children and whatever else, because banks are not in the business of taking risks at all. They are in the business of renting money. And so that's why even if you're prepared to guarantee it, the SBA loan guarantees for the small independent businesses can backstop your guarantee so the bank will do it. But to try and get a loan for the kind of high growth startup we're talking about here, not a chance. All right, you can't get free money, you don't qualify for a grant, you can't bootstrap it, and you can't go to a bank. What's next? Well, the only other option then is to get money by selling a piece of your business. It's called raising equity, and that's what most of you thought you were coming in here to learn about day one, and that is what we're going to concentrate on for the rest of this session. Because raising equity means selling a part of your company, trading part of your company to somebody in exchange for money and funding that goes into the company to help develop the product or service. So, who do you think the first person to exchange money for ownership in your company is? And don't all shout at once because there is one and only one answer, and that answer is you. You will be your first investor because I guarantee you, if you don't risk your personal money on your personal venture, nobody else will ever invest a penny. Why would they? You know more about it. You know more about yourself. And if you're afraid to take the money you were saving for your vacation or something and put it in, I guarantee you they won't. And then you say, well, I don't have a whole lot of money. And the answer to that one is it doesn't matter, because the more important thing is not how much you put in, but how meaningful the investment is to you. So if your life savings are, $25,000 and you put 10,000 of it into this company, that's fine. That shows that you're really serious about doing it. And then you can go on to other funding sources. So do not think that anybody will invest money in your business until you have put your cold, hard cash in there and it's in the business and that's what they are buying into. Okay. Who's next after you put your 10,000 or whatever you have to put into your business in there? Well, next up, traditionally, in the early stage startup world, we call this the friends and family round, but it's actually more than friends and family. And historically, it's been known as the 3 Fs: friends, family, and fools. I would add another one in there these days: friends, family, fans, and fools, because if you have people who really like what you're doing, you have a product that has internally generated fans or participants or users, that can be really good. So your family is investing not because they are investment wizards, they're not Warren Buffett here, but what they are people who respect you and trust you. And so A, they may be the only game in town, but B, they also often serve as validation for other investors coming in who say, hey, if you people who know you are willing to invest in you, well, that's a good thing. And that makes me a little more comfortable about doing it. In recent years, it has been pointed out to a lot of old white males like me that a lot of people, particularly founders from underrepresented backgrounds, do not have friends or family who have the money to invest in their companies. And so therefore, a new term is increasingly finding relevance these days for this first round of cash after you. And that's what we call the hustle round. And so basically, the hustle round is the same as friends and family. It's wherever you can get this from. Anybody you happen to meet in the chat room, somebody who is in the industry you're working with, whatever. And these are people who are investing as much for emotion, as much for you, for other reasons. And this will be any cash you can get in there. So let's say you managed to finally get somebody to put some cash in, or some buddies to get enough cash to get going, and you've gotten close to having your prototype or your first version, first iteration of your product. Now you can begin to talk to people who actually do this, if not for a living, at least on a serious basis. And so who would that be? Well, the first group of professional investors who invest in startups are, ta-da, angel investors, people like me. And there are a lot of them around. By some accounts, there are 300,000 people in the US who have done an angel investment within the last couple of years. I may question a little bit of that number, but there are a lot of these angels out there. They come in all shapes and sizes, and very often they are former entrepreneurs who know what it's like to start a company. After angel investors, but because they're investing, relatively small amounts, the next bigger amounts now come from who? VCs, venture capitalists. Venture capitalists that's their business. They are in business to find the next Apple or whatever and put their cash into these things and fund the risk capital up front that these businesses need to grow very, very big. And so now when you look at angels and you look at VCs, people often use that as a, one single word with no spaces, angels and VCs, or I'm going to go raise money from VCs and angels, but they're really not. They're really quite different. And you have to understand why it is that they're different, right? So angel investors are what I call rich-ish people. People who are really, really rich, the kind of lifestyles of the rich and famous people that you see, don't have the time or the inclination to invest in crazy startups. So angel investors are people who typically have net worths in the millions of dollars or tens of millions of dollars, which sounds like a lot of money, except when you realize that Elon Musk has hundreds of billions of dollars out there. So people like Elon Musk and Bill Gates don't go around investing in startups. The people who are doing this are people, often former entrepreneurs, who have made their money and are now participating in this next generation of growth and new companies, right? And so they invest their money because they want to make money. Number one reason. They invested because they enjoy the whole process of starting a company. They want to support people, a whole bunch of reasons. In contrast to them, venture capitalists, VCs, are professional money managers. Their job is to manage other people's money into these early stage startups. And so VCs get paid for doing that. They go out and raise a big pool of money from companies that have lots of money, people who have lots of money, such as the aforementioned really rich people who are not going to invest themselves, but they'll give $50 million to Sequoia or something to go invest in early stage startups. Things like insurance companies, pension funds, other players who have lots of cash on their books who will put a little bit of it into somewhat risky venture capital to make higher returns. So that's the main difference between angels and VCs. And that plays into what kind of money they invest, how you pitch them, and when in the process you deal with them. Before I go into how to actually raise money in there, let me tell you about two other potential sources here, right? One of them is our accelerators. Accelerators started by Paul Graham with Y Combinator about 15 or so years ago. These are mentor-based programs where They typically, and they're following on very much almost to the letter, the original Y Combinator model of 15 years ago. They will take applications in, they will select, anywhere from 10 to 20 companies into a cohort of their program. They will bring you in for 3 months. They will often give you a little bit of money, not a big major investment, but they will give you, often things like, $10,000, $20,000, $30,000, basically to cover your expenses while you're in the program. These programs typically last 3 months, 90 days. You will be meeting with mentors, meeting with other people in the program. And in exchange for that, they will take equity, typically 5 to 10% of equity in your company for this intense work. And then when you graduate the program, they will have a demo day, introduce you to other investors, and if you actually have a viable business and other people invest, they will often co-invest alongside as an accelerator out of a separate fund that they invest in. So accelerator programs are different from something called startup studios. A startup studio, you may heard of that term, is often founded by an entrepreneur. The first startup studio, the most famous one, is Idea Lab, started by Bill Gross out in Pasadena. But there are other ones here. There are Beta Works in New York, and a bunch of different ones. And these are ones where somebody has an idea, some entrepreneur who has lots of ideas and a fair amount of money says, okay, we're going to create a new company. And they will go in and bring an entrepreneur in, put that person on some kind of salary or stipend for a little bit to see if they can take this idea and turn it into a company. And then they will provide a lot of the back-end infrastructure and support for it to grow it and ultimately get it financed, with the entrepreneur at the end of the day owning a pretty big chunk of the company, although not as much as if she or he had started it by themselves. The studio gets a big piece of that action there. So there you have angels and VCs, accelerators, startup studios, all of which have one thing in common. They can do this legally, and they can do this legally because they are all what are called accredited investors. Accredited investors, this is a U.S. rule by the U.S. Securities and Exchange Commission, which says that if you want to invest in an unfettered way in equity in companies, you have to either have an annual income, steady income of $200,000 a year, typically for 3 years back and 1 year forward, or if you file jointly with your spouse, $300,000 in income, or if you have $1 million in assets, not including the value of your home, so you can sort of hopefully afford to lose it. Or a new addition that was added this past year is if you have a brokerage license, a Series 765 or 82, that qualifies you as a sophisticated enough investor so you can become accredited. And so all of those people have to be accredited. Friends and family are typically not accredited, which can be a bit of a pickle because you really only want to raise money from people who are accredited investors legally, or you got to jump through a whole bunch of hoops. Okay. Let's put this all into one chart and take a look and see what the timing is versus the amount you're going to raise versus the sequencing over here, right? So on this chart, the left to right x-axis here is about the sequence of your business from when you have an idea to when you're profitable. And the y-axis is how much money you're raising. But note that this is not a linear scale, this is a logarithmic scale. So each of those is 10 times the amount. If I had to do this on a linear scale, the top of this graph will be way off into the stratosphere here, right? So 100,000, a million, 10 million, 100 million. So who was the first money into your business? As you heard, and as you know, it's you. You are putting the first cash into your own business. That's taken for granted. That's founder equity, founder cash into your business. After that comes typically the 3 or 4 F's, right? The friends, family, fans, fools, whatever random people you happen to meet on the street. Accelerators will come in at this level as well. And typically here, you're raising in things that smell like tens of thousands of dollars. It could be more than that, but it's not typically millions of dollars. It's tens of thousands, and you often can raise this money very early stage when you have an idea, a plan, you're just starting out, because these are people who aren't making real business decisions, they're making bets on you. It's after this stage that the angel investors come in. And angel investors can cover a pretty wide range, but typically the average individual investment from an individual angel investor is in the tens of thousands to hundreds of thousands of dollars per investor, per company, per round, which means that you can get 20,000 from an angel, you can get $1 million from a very few, some of them, and because they're investing personally, they can invest at any stage they want to, which typically means you have to have some kind of traction first. We'll talk about that. You've got got something going, you got prototypes, you've got customers out there, they want to see something. And that's an individual decision by one individual angel. Next up is when you get these folks together into a room and they now become organized angel groups. This is also the same general level where seed funds play, venture capital funds specializing in very early stage opportunities. This is also the place where the follow-on rounds from accelerators come in. And these are investments in typically the hundreds of thousands of dollars in aggregate to the very low millions. And this typically requires more things to show than just an idea or a plan. You're typically not raising this unless you actually have sales, have customers, have some kind of proof that your wonderful idea is actually going to bear fruit. And you'll notice that all these things so far, investing in your company up to millions of dollars, we haven't yet talked about venture capital because they're the ones who come next. And VCs, who are typically investing in the millions of dollars to tens of millions of dollars in your company, these are typically coming in after you really have action, have growth in your company, and they're putting in money to scale and grow the company. And then finally, when the company has been successful in doing all this kind of stuff, the wonderful holy grail of raising money is from ta-da, your IPO, your initial public offering, where you sell shares of your stock to the general public in an IPO. And so that's what this looks like. Equity crowdfunding, you say, well, wait a minute, I didn't mention equity crowdfunding. Now, you would think that equity crowdfunding, which has been touted as a way to get lots of money early on from the masses over there, would be up in the left-hand corner here, raise a lot of money early on. No, it's not. It's actually in the bottom right-hand corner, because if this is where you have funding from people who don't know you, who are investing their little bit of cash into your startup company legally, because they can do it through these platforms that are known as funding platforms, licensed by the Securities and Exchange Commission. And typically, it turns out the average total raise for one of these companies going through equity crowdfunding on sites like Start Engine or WeFunder or Republic or Seed Invest is about $300,000. So you're raising typically much less than you'd raise from VCs or even angel groups, and about maybe what you'd find from angel investors over here, except that to do that, you better have a full-on offering memorandum. You're really going to require traction and sales and revenue. And so that's why this kind of equity crowdfunding is typically not the right kind of equity crowdfunding for the high growth startup. It's actually paradoxically and counterintuitively much better for the small independent business that has actually got something up and running and people can see what they're getting. All right. That being said, take a guess as to how many of these things get funded by how many of each of these. So let me take some random numbers from a few years ago from the US. How many startup companies were started? Well, if you count incorporations, there are millions of them, but some of those are just an LLC. You're incorporating for your own stuff. You're not doing it businesses. Let's take the number of businesses that actually hire employees, incorporate and hire employees. 700,000. Order of magnitude, rough number, employer businesses started every year in the US. So where does the funding come from those things? Surprise, surprise, it's not VCs. The majority of funding, startup funding and financing for those 700,000 new employer businesses is coming from the founders themselves. That's the first place you go. It's your own cash. You got to put your own cash in. And then after that, the next enormous chunk comes from friends and family. Again, you haven't even hit those angels and VCs yet, right? So of those 700,000 startup businesses that got started there, only 50K get their money from angel investors. And the number who get their money from VCs is tiny, right? Typically a few thousand a year. So forget all these videos and all these blog posts. You can be a quadrillionaire in 2.5 hours with ChatGPT, press this button and we'll make a fortune. Doesn't quite work that way, right? All right, let's say you know who you are, you've gotten past the first stage, you're now getting ready to hit angels or VCs and you're looking for money. And when people come and ask me for money, and I've been doing this now for decades, I find that they typically fall into one of two camps when the attitude they bring to the operation. What's the first attitude? This is the bro. This is the master of the universe. Hello, I've got the most amazing company you've ever seen. Guaranteed it's going to be a unicorn. It's going to make you more money. Getting around FOMO, fear of missing out. Get it while the getting is good in there. That is not a sales pitch. I don't know any investor who responds to that. On the other hand, the opposite approach, which probably accounts for a majority of people I see from it, is the Oliver Twist approach. Please, sir, may I have some money? I'm a poor little, that doesn't really work either. We want you to be somebody who we would have faith in, who can make money for us, right? So try and avoid both of these kinds of approaches. And the way to do that is to understand one of the very key things. And if there's one takeaway, it probably is going to be this from this discussion today. And that is understanding the fundamentals of the whole pitch process. And those are that the investors, the people you are pitching, their business is investing. They're professionals, either angels or VCs. They have a thesis. They know what they want to invest in. It can be a very, very narrow thesis. I only want to invest in, SaaS companies with $2 million in revenue in Tuscaloosa, or it can be a very wide thesis. I don't know what pornography is, but I know it when I see it, kind of thing. They have a general thing. I want to invest in interesting companies. But whatever their thesis is, they know what they're looking for, right? Meanwhile, you have a company. Your company does not depend on what they're looking for. Your company depends on what you are doing with your company. It's not based on investors. It's based on you. And therefore, your entire goal in creating a pitch for investors is to clearly explain what your business is. That's all. Not to entice them, not to pull the wool over their eyes, not to bullshit them, not to use magic words like AI or blockchain or whatever it is. It's to be as clear as you can about what you're doing, because the business will live or die on its own. And here's the gotcha. If it so happens that your business fits their thesis, then it does or it doesn't. It either does or it doesn't, right? If it doesn't, there's nothing you can do to make it fit your thesis, because that would be changing your business. And in theory, you've come up with the best business that you can, right? They're not going to change their thesis because you come along. You'd be amazed how many people say, oh, David, I've got a great gaming company. My thesis, I don't invest in gaming companies. Nothing wrong with gaming companies. I just don't invest in them. You can have the world's greatest gaming company, guaranteed gazillions of dollars. I won't invest because it's not my thesis, right? So therefore, binary. You fit their thesis or you don't. And if it fits, then both of you are coming in on an even playing field. Then they want to invest in you and you want their investment. So you're coming together as equals. But if it doesn't fit, then you shouldn't even be pitching them. And that's why it's so important to figure out who you're pitching to make sure you've got the best shot at matching up your company to what they're looking for. So, as I said, every investor has a whole thesis, which can be wide or narrow, but all of these theses for all these investors start with three things. And what are they? Well, the first thing is people, great people. We say in the business that we would much prefer to invest in an A+ founder with a B grade business plan than a B founder with an A business plan, because it comes down to people. And not only people in general, it comes down to one person, the one most important person on the team. And I'll give you a hint as to who this person is. It is not the techie. It's not, despite the fact that Paul Graham only will invest in a hustler and a hacker, it's not the techie, it's not the UX designer, even though UX is critically important these days. You say, oh, is it getting people to buy our product? It's not the salesperson, because you got a whole business to run here. But you know what? It's not the business person either. So who is this magical person the investors are looking for? They are looking for the magical person known as the big T, big E, the entrepreneur. And it doesn't matter how you got to be an entrepreneur, where you're coming from, right? You can be a techie combined with an entrepreneur, in which case you're Bill Gates. You could be a UX designer combined with an entrepreneur, in which case you're Steve Jobs. You can be a salesperson combined with an entrepreneur, in which case you're Richard Branson or Mark Cuban. You can be a business person combined with an entrepreneur, in which case you're Michael Bloomberg, right? It doesn't matter what your background is, the entrepreneur is the person we're looking for. And so therefore, when you are standing up there pitching, we as investors are looking for the entrepreneur, and who the entrepreneur is can only have one answer. And that answer is you. Only the entrepreneur can give the pitch. I don't care if English isn't your first language. I don't care if your marketing person is gorgeous. I don't care if your sales guy can talk the leaves off a tree. They can't give the pitch. Only you as the founder, because I'm investing in you. And so therefore, when you think about this pitch that you are giving you, when you are standing up in front of these investors, you have to ask yourself the $100,000 question, which is, Why are you standing there? Why didn't you just give them a video or give them your deck to read at their leisure or give them your business plan? And the answer is they are trying to get a measure of you. And each of these investors has their own internal rubric for what they're looking for. But here's mine, which is, I think, generally applicable, right? What is the single number one most important factor from anybody I look for? And I'll let you take half a second to think about that, and I will tell you the answer. The number one characteristic out of 10 characteristics, the number one I look for is integrity. Because if I can't trust you, we're hosed from the start. If I get the slightest hint of anything not completely clean, I'm out of here, right? Integrity, you will hear this from multiple investors, really important because you're making decisions every minute, every hour. And if I can't trust you to make decisions for the good of the company, I'm not going to invest. And then after that come a bunch of other things, right? Passion. You have to have passion for your business because starting up a company is an insane, crazy, nasty, brutal, short thing. And you have to have something that drives you, and that is passion. Without passion, you're going to fail. I guarantee you. And then we look for experience, right? We look for startup experience. Have you ever started a company before? Okay, if you haven't started a company before, everybody's a first-time, entrepreneur at some point. If you haven't started a company, then we'll say, have you done anything like starting a company? Started a project in school, led a team, done a charitable something. We want to see something that can give us an indication that you know how to motivate people and see something from ideation to its completion over there, right? Another kind of experience we want to know is, do you have experience in the domain in which you are investing? And this has bitten me multiple times. You have a great idea, great founder, but they don't really know about their domain. So knowledge about what you're doing, really, really important. And then when you're starting a company, the McDonald's can have, tens of millions of employees, and a hot dog cart can have one employee, but the roles that have to be filled, the skills from cooking and serving and budgeting are all the same, which just means that, somebody at a hot dog cart has all those skills, and if there's only one employee, it's got to be the hot dog cart owner who does all those things, right? So we need to look and see, do you have the skills to run your business? And realistically, not everybody has every skill set. So therefore, you're going to have to augment your skills typically with other people, which means we're looking for leadership. And are you the kind of person we would follow as a leader? What drives you to be a leader? What is it that drives us to believe that you're there? One of those things is commitment. We want to know that you are committed to the end of this game. And as an investor, the minute you take my money, you lose optionality. You have no right to leave the company until I drag it from your cold, dead fingers. So you better be committed to stay there as long as it takes. And what drives you to do that is your vision for the future. This is the one place where your vision comes in about changing the world. Apple Computer's original motto was Apple Computer changing the world. And the second line of that was one person at a time, which gets to the next piece, which is realism. So I don't want you to tell me about how you're going to, serve 10% of the people in China. I want to know how you're going to sell the first person and the second person and the third to get out there. And then finally, no startup, Sun Tzu, no startup survives first contact with the enemy. No startup survives first contact with the market out there, right? And your business plan, whatever it is going to be completely shredded the minute you try and go into the market. And therefore, you got to be flexible. You got to be coachable. Don't necessarily do what I tell you, but be willing to listen to me, right? So these are the things that we look for that you are conveying in your pitch when you pitch. That's all I'm going to say about how you're going to pitch. And we're going to have another session in this series with Gust about how you actually do your pitch. And I'll reiterate this again then, but then I'll go into a lot more detail. But for now, we're looking at the person. All right. What's next? The second thing that is in every investor's thesis. If I'm investing money in this really risky startup business, it's got to be scalable, right? What does scalability mean? Well, there's the subtitle in my book. Scalability means you are starting a business that can start small. You can't, a nuclear power plant is not scalable. You got to build an entire multi-billion-dollar nuclear power plant, right? On the other hand, a subscription service where you're building the box in your bedroom and sending it out, that's scalable. You can start with one box, and then as people buy and buy more, it grows and scales. So I want to see something in a business model that says you can start small, take my money, prove it works, and then with more money coming in, make it bigger and bigger. And I'd love to have you prove it before you take my money and use my money to make it bigger. But there's also a second piece to scalability, and that is, as it gets bigger, I want to see a business that gets better. that the bigger it is, the better it gets because of economies of scale, because of network effects. I mean, if I asked you to, go and create a website to sell my book right now, you could do it, but it would cost more than it cost you getting selling one book. If I asked Jeff Bezos to sell one book of mine, his marginal cost to sell my book are effectively zero, right? So we look for businesses that are scalable, start small, can get big, and get better as they get bigger. And then the third thing that everybody wants to see is traction. You say, oh, okay, I keep hearing that ad nauseum from every one of these investors. Hey, I got all of this really cool. Look at that. I got my MVP. I got the best team in town. I got amazing advisors. Well, you know what? One of my favorite lines, one of my favorite movies ever made, The Princess Bride, is, you keep using that word. I do not think it means what you think it means. And so the point is, what you think traction means is probably something like a really great idea that you've got, and you've hired employees, you've hired them, you've got advisors to join your team, you've filed patents, you've got issued patents, you've built your product, your MVP, you've got it in market, you've got a business plan that shows how you're going to make a fortune, you've been buying AdWords on Google and Quora and every place else, you've got wonderful, amazing press coverage about how you're the second coming, you've taken out all of these AdWords, you've raised a whole bunch of angel venture capital. Guess what? None of those count as traction. Sorry to be the bearer of bad news. Doesn't count. So you say, what the fudge? What is this traction of which I speak? And the answer is, traction is something that is outside of your control. Right? It's nothing, all the other things on the previous page you could do. You can't make this stuff happen. It's outside of your control, and it demonstrates that you have created economic value for somebody else. And that value is getting bigger and better every day. And so think about how you prove that you've created value for somebody else. And the easiest way, the easiest, cheapest form of traction is, ta-da, paying customers, because if they're willing to pay something and it costs, they're willing to pay more than it costs you to build it, you have created real value for them that they are willing to pay. Okay, we're going to be coming into the home stretch over here. We got a lot of stuff to cover, and I'm going to do this really fast. If you think I've been speaking fast until now, we're going to even ramp up the speed and speak even faster. Luckily, we are recording this entire video, so you can play this back at your leisure at 1.5 speed and get all these wonderful pearls of wisdom over here, right? So because the next stuff you have to do is you sit down to start your fundraising is you got to start by asking yourself a bunch of questions. And we'll go through how you answer these questions and what they mean for what you're doing, right? First question is, how much am I raising? Why? What decides how much I raise, and when in my company's life cycle am I trying to raise this money? Next, what does that mean for which round this is? What do I call this round? What do I tell people I'm doing? Who should be in this? What kind of investors am I looking for, right? In terms of actual timing, when? I mean, do I do it right this second? Do I do it, in Christmas? When should I go out to start looking for funding? When I go out for funding, what is the structure in which I'm asking people to invest? There are a lot of different ways that you can invest in a company, and you have to figure out the right one that actually makes sense. Valuation, this big term. What the hell is a valuation? And how do I actually decide what it is? Who decides what it is? And how do I get people to agree to my valuation over there? And then finally, I keep hearing about a lead investor, but can't I just do this without a lead investor? Can't I write a term sheet myself? And the answer is, yeah, you can, but a lead investor is something whose value is beyond gold, right? So, all right. Let's start with the first one of these. How much am I raising and when? And this one is a really tough call. There is never a great time. In the ideal world, you'd raise, you could raise enough money to raise for 24 months to keep you going, cover your burn for 2 years, right? And you'd raise well before you need it, so you can seamlessly go and grow the company. The challenge, however, is that raising money takes, if you're going to get it, going to be successful, it'll take 3 to 9 months on an average of about 6 if you're going to get it at all, right? And you can't do it until you have traction first. So to get the traction, you spend all your cash, you get really out on a limb. Now you got to raise money, and you'll take what you can get. So it's really, there's no easy answer here. Nobody has fun and games, but really think through and understand what's going on. These are your goals. Do the best you can. In terms of what we call this round, the names keep changing. The names have changed half a dozen times since I started being an angel investor over here. The first round, that's the founder round, goes without saying, this is your cash in there. But when you do these rounds, rounds, and a round is when one or more players invest on similar terms at a roughly similar time, right? So therefore, your first round, whether you call it the hustle round or friends and family or whatever, the 3Fs or 4Fs round, this is typically in the hundreds of thousands of dollars, and it'll be done early on, right? From there, you then move into a pre-seed round. These new things just basically have been invented recently, but a pre-seed round typically is about $500,000 to $2 million, which sounds crazy for me who's starting out in a world in which, that was a Series A. My first Series A was about that amount of money. But this is a pre-seed round. Seed rounds are more. Seed rounds these days are where many of you will be aiming at in the pre-seed and seed universe, where you're raising between 2 and 5 million. Typically, this is where angels and seed funds come into play. And then it's really usually only until you get up to a Series A, which is the first round that VCs come into play, where they're investing 5 million, 10 million or more at double-digit valuations, right? And so speaking of valuations, do not believe the hype. If I asked any of you, wait, what's a typical round for a seed round? You're going to tell me, oh, it's, a 10 million valuation, 20 million valuation where I should raise $5 million. Bullshit. Not the case, right? These are the actual valuations for seed rounds from the past year from the Angel Capital Association's own survey, right? And the average is just about 6 million, 6.5 million pre-money valuation, right, for the round, which raises now typically at these seed rounds in the million plus couple of million range. And pre-seed valuations are lower than this. So you should be looking, whatever you're doing, at things that smell a lot closer, especially in this market, to 3, 4 million, 5 million, things like that. So when to raise, summer VCs unfortunately tend to go on vacation in summer and they go skiing in winter. And so trying to start your raise in the beginning of the summer or in December when they're trying to get other deals closed is going to be challenging. You often can't pick your time, but if you can, try and avoid those rounds, right? Let's talk about the structure. This is a really key point of what we're doing, and we may actually end it a little shortly after this. So there are multiple structures, ways in which you can invest money into companies, right? We talked about grants. Grants are essentially our free money. You get a check into your bank account. They say, try and be a good girl or good boy and use it for what you said you use it for, and that's it. You don't have to do anything else about that, right? A loan, as we talked about, has to be paid back. A loan has to be guaranteed by somebody and has to be paid back, typically not available to startup players, right, to high growth startups. On the other hand, that means you have to sell stock, and selling stock, you're selling a piece of your company and a piece of the pie to somebody else who now is a partner with you and owns part of the company. The problem with owning a part of your company, it comes into what happens if the company doesn't do very well and there's only a little bit of money at the end of the day when the company shuts down. If they only buy 10% of the company, they only get 10% of that cash, even though they put in a lot of cash invested up front, more than you. So therefore, there's something called preferred stock, and preferred stock, people invest in the company, but it gets paid back first. In a bad scenario, that cash comes back first before anybody who has common stock gets paid. The challenge with that is it doesn't get a piece of the upside. Also, this is requires a valuation for the company, knowing exactly what the company is worth, when often for a startup, you don't really know that. And so therefore, what most angels have historically used for these pre-seed and seed rounds is something called a convertible note. A convertible note is a loan, but everybody knows the goal of this convertible note is to turn into stock. And so therefore the loan converts into stock when the next guy comes in, the big VCs. Because this is debt, which means it gets paid out first if bad things happen, and it has a maturity date, which means you got to pay it back, at some point, even if you don't do another round. Y Combinator, with some of its fancier schmancy companies, started something called the SAFE, and a SAFE stands for a simple agreement for future equity, and I call it not a loan that converts to stock. It basically looks like a loan, smells like a loan, except it doesn't have the protective things for an investor of being a loan. It means that basically you're promising to give them equity. They do get paid back first, but they don't have a debt, so they don't have a claim on the company if you go under, and so on. And so therefore, what most VCs use, all Series A's and above, and serious angels doing larger rounds, rounds is something called convertible preferred stock. And convertible preferred stock is this magic stuff that's designed for VC investors. It starts out as preferred stock. So if the company falls on hard times and is liquidated and there's only a little bit left, it all goes to the VC first to pay back the amount they put in. But then on the other hand, if good things happen and then the company is sold in a big acquisition for a lot of money, then presto changeo, good things happen and it turns into common stock and they can share in the upside. So that's the kind of thing that investors like to invest in. So we're talking before about valuation. So if you have a convertible note or a safe with a cap, or if you're buying common stock or you're buying convertible preferred stock, all of these mean that somebody is putting in money and buying a piece of the company. And how much of the money they're putting in and how much they're getting for what they put in is the function of what the value that both people bring think the company brings to the table, right? They're putting in hard cash, you're putting in a company, the ratio between the two decides how much they get. And so now let me give you the secret and scary thing about the valuation economics of the angels. And this will clear up one puzzling question, which is angels say, hey, if I can get 25% return on my angel investments, I would be very happy. And you would say, oh, that's really cool. I'll buy. I think that's a nice idea. I think that's totally fair. My goal is to get you a 25% return over here. The problem with this is that as angel, we've done a lot of deals, and we know that only 1 out of 10 companies in our portfolio will go really, really big. And we don't know which one it's going to be, which means that we have to calculate every company as if it was the only one out of those 10 that made that money. And so therefore, that means that every single deal that we invest in, we have to pencil out as potentially returning 30 times our investment. So think about what that means for your valuation over there, right? If you are talking about a valuation of, 5 million valuation, that means you better be able to sell this company for $150 million, having taken in no additional money for me to get my 30x return on here. And so that's really, really challenging, which is why getting any deal done is a pain in the neck and is very difficult. Not all deals happen. Many, if not most deals don't happen. And so therefore your search, the first search you are going to make is for this elusive lead investor. The lead investor is scarce than the unicorn, but twice as valuable because they are the people who can help bring other investors in here. They're smart money, so they can add real value to the table. They got a great reputation, so people will follow them. They're committed to what you're doing to support you in bad times as well as good times. They've got deep pockets, so they can come in for follow-on rounds. They've got other investors. They like you, you like them. If you can get a lead, that is by far the thing you're looking for. But ultimately, when you're looking for investors, you've got to treat this as a sales funnel, just as you treat the sales funnel for your property, for your own company. And so therefore, you want to identify lots of investors. I say 50 here because that's the absolute bare minimum. If you're not talking to 50 investors, you're host. In most companies who are doing this, most founders who are serious are talking to 100 or 200 investors because only a few of them are going to be the right ones, right? Because out of all these investors you reach out to, you got to qualify them to find the ones that are actually the right ones whose thesis matches what you have. Don't try and fit a square peg into a round hole. You want to go ahead and find the one who matches you. And then you want to meet them, right, by getting in contact with them through somebody, and ideally a warm introduction, which would be really, really cool, and then use them to leverage everybody else. So how do you find angels? And then we'll end it and we'll take questions from there. The first thing is the most obvious. You find angels by saying, you're looking for angels. Hello, anybody, tell everybody, tell your friends, tell your mother. I mean, literally, I have been pitched deals by my mother, my barber. I mean, tell everybody you know you're looking for money over here because you never know who can connect you. But then there are some platforms that do this. One of the great platforms that I love, that are done by friends of ours at the venture fund NFX, is a platform called Signal. And Signal has thousands and thousands of individual angels and VCs who filled out full profiles, and you can see if they lead, what areas they invest in, if they write checks, if, how big a check they write, how you're connected to them. Really, really helpful. If you're looking for angel groups, hey, look for Gust. That's what we have, this whole platform. We back end the majority of the world's angel investor networks. And so once you create a Gust profile, you can go ahead and use that to apply for funding to any group on the platform. Other places may cost you a little bit of cash, but you can find potential investors. Crunchbase is a paid service, but you can find other people who are looking in your area, see what their thesis is. LinkedIn, a lot of people who are investors, VCs or angels, will put it in their profile that they're there, and it's not a great way, but it's a viable way to do it. The Global Accelerator Network is a way you can reach out to lots of accelerators. You can also find a lot of them on Gust itself and on some other sites. And then if you want to find even angel groups that are not as smart to use Gust, and there are some smaller ones out there, you can go to the Angel Capital Association's website. And so these are all great places to find investors. So with that being said, we've just hit an hour over here. And so there is lots more we could talk about. There will be lots more things in this series that Gust is doing. We have all parts of the whole fundraising and company startup and growth process covered. I would encourage anybody who is interested to check out, this is a resource page I put up for exactly folks like you, davidsrose.zealous.space. You can use your QR reader to scan it right there on the screen. And there you will find links to all the stuff we have at Gust designed for startup founders, to my background, to the things we invest in, to various presentations, including a version, hopefully, of this, which will be up online. And that's a great place to start. So with that, and being just about at the 1 hour mark on time, I will turn it back to Peter.
Amazing, David. I can't believe that you packed that much in. We have a ton of really interesting Q&A, but before we get into that, for the people who have to leave, can you give us just 3 top line key takeaways? And since it's you, if you want to do 4, you can, but just real quick, 3 to 4 key takeaways.
The top 3 takeaways, right? So number 1, as we discussed, the pitch fundamentals, right? They have a thesis, you have a business. Your goal is to clearly explain your business to see if your venture fits their thesis or it doesn't. Right. And so that's the round peg in the round hole. Your goal is to match your peg with their hole, and to not waste time trying to beat somebody or con somebody or sweet talk somebody into investing who isn't there. If they say no, boom, cut and forget, and cut and run, go somewhere else, right? So you want to find investors who fit your thesis. And the way you do that is by the sales funnel, right? You want to go ahead and identify as anybody who is remotely within your universe, find lots of investors at the top of the funnel, because investors are doing this in reverse. They're looking at lots of companies and trying to qualify ones to invest in. You got to qualify them. You do this by finding the ones who are most aligned to your thesis of what you're doing, and then find out how to get in touch with them. And LinkedIn, by the way, is a wonderful way to do it. You should be able to reach almost anybody somehow, some way through LinkedIn, through somebody you know. I wouldn't make the introductions through LinkedIn, but I would use that to find who you know and then reach out to your people you know personally to make the introduction for you. And then when you get there, learn from every pitch you do. The more pitches you do, the more practice you'll get at doing it, the more feedback you'll get, and you'll understand what people are understanding about it or not understanding about it, and why it, or whether it fits, or what kind of investors you're looking for. Very important. And then finally, close that. And when you get one investor, really work with them and lean on them to try and get other people to invest in it. That's number 2. And the third takeaway, which we didn't have time to do now, but we will do in our future session on how to pitch, is when you do your pitch, people think of a pitch as one thing, but it's not. It's one presentation, but it's done in 3 different ways. So you do 3 different versions of your pitch. We call them one to throw, which is you're going to throw it out ahead of time. This is the teaser. This is a relatively short pitch. It's a few slides, easy to digest, that tells people what you're doing. Because remember, the goal is to make sure you match their thesis. And so they can quickly, I can look at a deck and within literally 30 seconds, see if it's within the universe of my thesis, right? So that's your goal. That's with the teaser. Then you have the one to show. This is the one that you use as your pitch when you're in front of your investors. And we'll go into a whole session here in this sequence on that. And that's all about telling a story, a really wonderful story that will be compelling for them to do. It's going to be very visual, very emotional, not crying there, but it will hit their emotional hot buttons, and very logical as you go through it, but it's not going to be full of detailed text. That you save for the third version, which is the detail leave behind. And that's where you'll have all the stuff you can't talk about that because you're not going to be there. So they have to look at this after they've seen your presentation, after they've been completely amazed by what you're doing. They'll leave behind, let them go in and look at the numbers in detail. And so those are my top 3 takeaways for what you need to have when you're pitching an investor.
Awesome. Thank you so much, David. All right, before we move into Q&A, please check out the chat. Ryan is going to post just some social links and some other resources to keep up with us. We have a very jam-packed content and programming schedule through the next few months. So if you want to keep up with that, keep up with us on social. And now moving into Q&A, we are going to stay for the next 30 or so minutes to get through as many as we can. So if you can stick around, please do. Otherwise, we will send the stuff in the recording and provide some opportunities for follow-up. So David, the first question we have, and this covers a set of questions, but as an investor, do you feel that there are any downsides to crowdfunding for early investment? And we can treat rewards crowdfunding and equity crowdfunding.
Sure. There are two types, as we discussed, of crowdfunding, right? One of them is rewards crowdfunding, and rewards crowdfunding is a great way to bootstrap. Rewards crowdfunding lets people pay you to develop your project, and it provides some ability to demonstrate that there's a market fit. If you get people to fund it, and then they're happy. So rewards-based crowdfunding is an unadulterated good, right? If you have a kind of product that you can get people to pay for it, absolutely, right? Equity-based crowdfunding, as I think I showed you and maybe surprised you, is a very different thing, right? Equity-based crowdfunding is not appropriate for the vast majority of these high growth companies. You're not going to raise that much cash, not as much as you'd raise from angels or even a pre-seed round. It's going to require that you be a lot more advanced than you probably are right now. If you're not advanced enough to get funding from angels, you're not going to be advanced enough to get funding from equity crowdfunding raise out there, right? So the purpose for equity crowdfunding platforms is to raise money for that first hustle round, from people from your customers, from your friends and family, to do it legally, to let them put cash in it. So think about equity-based crowdfunding as a tool, not as a source.
Awesome. Next question. Would you recommend that someone always do a friends and family round?
No, there's nothing magical. To the extent that you can skip around, that's great. There is nothing magical about it. If you have the kind of business that lets you go right to an angel round or right to a VC round, go for it.
Awesome. All right. Next up, do you know off the top of your head the number of angel-backed startups that actually ever reach certain revenue markers? So 1 million in revenue, 10 million in revenue. How many of angel-backed startups actually get to those benchmarks?
We don't have exactly those numbers because the numbers are very hard to find. Gust has some great numbers on the inbound side. The Angel Capital Association does a survey every year to try and get the other end, but there's no official reporting for it. So a lot of this stuff is self-reported. I would have to guess that probably a majority of angel-backed companies will get to 1 million in revenue. Probably a minority will get to 10 million, and only a relatively few will get above that.
Awesome. Next one, I'm going to combine a couple, but it's all about SBIR and STTR. The first is, if you get grant funding from one of these things, is this something that is generally thought of as attractive to future investors?
The answer is it's additional cash that lets you grow the company even more, and there's no downsides. So so as far as investors are concerned, this is great. You managed to get cash. You didn't give up equity for it, so there's more equity to go around. It was non-dilutive capital, so that was great. There's no downside in having raised previously from an SBIR grant.
Awesome. And following up on that, we had a few questions about how to think about when you should qualify or when you would qualify to apply for those things. I know in large part they outline the qualification criteria in each of the grants, but any other guideposts for when is a good time to start looking at that?
Literally reading the material is, I was brought up by my father, said, always read the instructions. He didn't always do it himself, but it was seared into me from an early stage. And reading the instructions is a great way to get started. The SBIR program is designed to put out money, so they make it as clear and as easy as possible, and they will tell you what they are looking for and when. And the good news is that these are really early stage. The whole purpose of the SBIR STTR program is to provide capital for things that are not currently financeable in the free market. So they are specifically going out for things that are pre-angel, pre-VC money that people wouldn't make a rational decision about. So therefore, it's early. Early is not a problem. Even a plan is not a problem, right? Although obviously the more traction works here as well, you can show the better off you are. But their goal is to help create new things that are good for society. So as long as you fit in their criteria, again, no downside. It may take a bit of a long time and be a little bit of a process with interviews and applications, but definitely worth doing because it's free money.
Yeah, and I mean, realistically, any fundraising process is going to involve a lot of time, effort, paperwork, and funnel management, regardless of whether you're going after grant or equity. And then the last one on that note, and I think this is more of a mechanics thing, but when you think about getting grant funding, do you think of that as a round?
Yeah, I mean, again, there's no official definition of a round, right? So there's no official definition of a particular round or even the concept of a round. So you would basically say we got an SBIR grant, right? That's great. So is it a round? Yeah, it's a round, but who's asking the question?
Yeah,
Investors aren't going to decide whether it's a round or not. It's realistically, yes, it is a set of money that comes in on some similar terms at one time. So technically a round, but you would basically just refer to it as a grant.
yeah, and I think it's important to think about, just when you look at these things, inputs, trade-offs, and outputs, right? Here, you've got the input of some amount of money. You haven't traded any equity or ownership for it. And then on the output, it's like, how well did you put it to use, right? So it looks kind of like a round, but you're not trading any equity for it. So you're not getting that traditional 10 to 20% ownership dilution for the capital that's coming in.
But remember, a grant doesn't value it doesn't provide any signpost
Right.
for valuation, right? And so it's just a good thing.
Okay, we have a question just regarding pitching. Anthony asked for clarification between the pitch versus the ask.
The ask is typically part of the pitch. The pitch is describing what you are doing. Remember, the goal is to clearly describe what your company is doing, is, and will be doing, and for the investor to see if it matches their thesis. So that's the bulk of it is. And then typically the end of the pitch is what you're trying to do. The reason you're pitching them is to get money. And so the ask is at the end of the pitch. Having done all this, love to have you in. We are raising, X amount of cash. We're raising X amount of Y valuation, whatever the thing is. That's where you actually ask for the check. I mean, you don't not want to have, basically people who send me emails saying, hi, here's what I'm doing. Sincerely, Peter. So, what's the ad? What do you want? Right. Yep. So make sure you ask.
Awesome. Similar one, or in a similar vein on pitching. We have a set of co-founders who are both previous entrepreneurs, both potentially involved in being able to communicate the strength of the team. How do you feel about two people tag teaming an investor pitch?
This is not high school, right? In high school, when you do a team project, you have 8 people get up there and everybody thinks their little section over there, and I'm the marketing person. No. The bottom line is, we love to see founding teams, as Paul Graham said, he invests in teams of a hustler and a hacker, but somebody is the entrepreneur. The buck has to stop somewhere, and that's the CEO. Co-CEOs do not work, right? There is one CEO. That person should be the primary pitcher. There are cases where, if there's a really technical person and one really business person, and they are really equal co-founders or close to equal co-founders, you will have the tech person, do the tech part of the pitch if that's really critical. Typically, the tech piece is not really critical to the pitch. So I would have the co-founder there to provide support, but not to get in the way.
Awesome. Next one is on fundraising instruments. Can you talk a little bit about preference between convertible notes and safes among investors?
Sure. So as I flew through at warp speed in the presentation, convertible notes came into play because what VCs invest in is called convertible preferred stock, right? And that is a Series A round, a Series B round of convertible preferred stock. And that is buying a certain amount of the company for a certain amount of cash with all kinds of rights. Typically, the documentation for these things is literally 100+ pages by the time you finish it. Historically, this cost $50,000 to paper on a legal basis. Even now, doing a Series A is non-trivial. You're still talking $20,000 of legal fees or whatever, because there's lots of things: shareholder agreement, purchase agreements, all kinds of things in there, and because it requires a valuation round, a valuation number, how many shares you're getting for the cash you're putting in, you got to value the company, and so Angel said, okay, if I'm coming in as an angel before the VCs are coming in, I'm only putting in $50K. I don't want to spend 20K going to pay to lawyers to pay for the documentation here. So I tell you what, I'll put it in as a loan, but that loan will automatically convert into equity when the VC comes in the next round, and I will take whatever valuation they're going to negotiate, because they know better than I do about what valuations are, and I'll come in at a discount to what they're doing. So if they say it's worth $100 a share, I get to come in at $80 a share because I came in first. And that was the thesis, from that. Then you get into the question of caps. And so historically, investors, angels started doing full-on convertible equity rounds. Then they switched to convertible debt rounds, which is where it's comfortable for an angel to invest, because a convertible debt is a loan, which means it's got a maturity date. Typically, these are 18-month, 2-year maturity, which says that, okay, you're going to, if you don't do a round in that time, you pay me my money back with interest in 18 months or 2 years. And so that sort of holds feet to the fire. And it means that if it goes out 2 years and the company has completely blown all of its projections and is a disaster, and it hasn't done all this kind of thing, then whatever the terms you negotiated before, you better have another talk with them. And you're in a position to have a talk with the company, because they have to pay, they theoretically have to pay back the loan, which typically the company will not have the cash to do. So theoretically, the note holder could force the company into bankruptcy, but they won't do that because there's no percentage in doing that. So instead, it means you have a little uncomfortable discussion about what happens next. And typically, the loan will be extended, or it'll convert into equity or something else, but it will mean it's a fair, even conversation. And because it is debt, if the company has a bad thing happen while the debt is outstanding, debt gets paid off first before any common stock gets anything. So before the founders get a penny, the convertible note gets paid off first. So for all these reasons, angels will either do full priced convertible stock rounds, or they will do convertible note rounds that convert into convertible preferred stock, because that's rational and safe for them. What happened with the safes was that Y Combinator was dealing with all these hotsy-totsy, California companies that thought they were, king of the universe kind of thing. And they were, at least when they started, they had a lot of people who wanted to get into their deals, and they were sort of in the driver's seat. And they said, okay, so we'll do this new thing that looks like a convertible note, except it doesn't have those protections for the investors. It's not debt, so therefore it doesn't have to get paid back if bad things happen. And it's not. It doesn't have a time limit, so I can run out the clock and do bad things and stuff. So, but otherwise, it's just like a convertible note. Over time, what started out as a simple agreement was literally 2 pages, has morphed into something that looks exactly like a convertible note, except it has better provisions for the company. So, if you can get a safe done, great, go do a safe. There are many investors, me included, who typically will not do safes because, for all the reasons I just explained, why we do convertible notes.
Yeah, and I think funding climate comes into play here too. For years, YC was building an integrated funding ecosystem where they were able to shoot people out on a jet that ran right into a seed or a Series A. That doesn't happen in every ecosystem. It certainly doesn't happen in the capital environment that we have now. So it'll be interesting to see if some of these things change. Okay. We have one on best resources for matching with small business grants, ESPR and STTR. I think local government websites, the federal government website, and then there are also some services that index these things and will help you match. And then David, we have a few questions around this topic of just revenue or sales benchmarks to be thinking about at different funding rounds. I know the names change. Right. So what are some general guidance?
The answer is very simple. It's not a hard number, right? There's no magic number. I have to have $1 million in sales, right? It's not that. It's traction. Remember, and the defined traction is something outside of your control that shows you have created economic value for somebody else, and that value is growing. So if your sales are, something that results in, $10,000 in margin per sale, and you got 2 this month and 4 next month and 8 the following month, that's great. That shows me you've got exponential traction, right? I hope you can keep it going, and that's fine. And, on the other hand, if you have, $1 million in sales, and that's good, and over the last 5 years, it's gone from $1 million to 850 to 900, whatever. Okay, that tells me, okay, this might be a very interesting, nice sustaining business for you, but it's not going to be the kind of growth scalable business that I need to see. So it's not a question of hard numbers, it's a question of traction.
Awesome, thank you. Next up, we've got some questions around international projects. Why won't most angels invest in my project that is based in Russia, in Egypt, in wherever? How do angels think about actually mechanically investing in these things? And what should projects that are starting outside of the United States be thinking about?
So historically, angel investing, remember, it was somebody who you know. There was no organized industry. The term angel investors applied to what we do did not even come into parlance until the 1970s, right? So put that in perspective when I was in college. And so it was an unheard of thing. And even from the 70s to the 90s, it was this weird little thing that nobody really knew about, nobody heard about. It was barely talked about. And there were no platforms and demo days and offsites and whatever. It was, you bumped into somebody, in your office at a country club and at a restaurant, and they said, "Oh, I've got whatever it is here," and they showed you, right? So historically, angel investing was very close to home, and angels were these people, these crazy people who did this thing, like my great uncle, to whom my first book on angel investing was dedicated. Who, I mean, literally everybody in the family, other than me, thought he was crazy. Oh, that's Dave's plaything. I mean, he would, this is a guy who was this amazing angel, and I was at a lunch with him and 4 Nobel laureates, an incredible guy at the forefront of all this kind of stuff. And everybody, literally in the family, thought that he was somewhere between infantile and investing in startup company. Wow, these crazy little things, right? And I found it fascinating. And so it was therefore, when you invested, you would typically put in your cash and get very involved with the company. You would want to meet with them. You became almost by definition an advisor to the company. And so you would, in some cases, be on the board, or certainly meet with the founder, every month, every few months, to see what they were doing, be helpful. And that is much easier if you were in town. There was no Zoom, right? Keep in mind, folks, Zoom is only relatively recent. And so if you wanted to meet somebody in person and keep in touch with them on a regular basis and know the market they were in, that was often very local. So historically, angel investing was very, very local. With the rise of, and it was also very US based, there were virtually no angels anywhere else in the world. With the rise of international angel investing and venture capital and the rise of the internet and growth of startups and all this kind of stuff, there has been this explosion of startup stuff happening around the world. The EBAN, the European Business Angel Universal Network, named me the Angel Inspirator of the Year for inspiring, I gather, angels across Europe. But still, angels have a tendency to invest locally, even if they don't go and meet you in your office every month. They think they might, or they think they want to touch base. That's slowly beginning to change. So now you'll talk to people on Zoom, or you'll get quarterly reports or annual reports, and that takes some of the face-to-face out of it. But old habits die hard. Number two, a lot of this stuff relative to the terms of an agreement and how you handle banking stuff and how whether you qualify is all regulatory controlled within your area, right? Whether it's accredited investors or whatever. And so investing locally certainly in the US is easier for an angel than investing internationally. There are many jurisdictions in which if I invest internationally, I have to have something that's medallioned with I have to get my official signature notarized in a special thing, special ink by a bank in person that has to be all this kind of stuff. If it's another language, I can't necessarily read the actual text of the document that I'm doing. It can be translated, but then, so it gets to be really challenging. And given the fact that angel investments are relatively small, right? Tens of thousands of dollars, typically, that doesn't make a lot of sense for international investing. So have I done a very few? Yes, but typically only under extraordinary circumstances, and most angels do not. That being said, there are, particularly in Europe now, a few cross-border angel funds that are doing things. The True Global Ventures, the venture fund, which I'm a founding general partner, is literally an international super angel fund where we all initially put in our own cash and we were investing internationally, and now we've taken in some limited partners. So you're going to see more of that over time. Platforms are going to help. Things like Gust. Gust has founders in 193 countries right now, which is really great. So we're helping to bring the world a little bit together with a standardized profile, but we're still far ways from people investing internationally. So I would absolutely suggest that you first, second, and third, look for angels in your country rather than trying to go for international angels. That being said, if your business is moving to the US because your clients, your customers are here, you're expanding for a successful business from your home country into the US, you're going to open an office here, here, then consider setting up, and especially if there will be somebody here, right? It doesn't make sense to open a company in the US if you're not going to have anybody here. But if you are going to have an office here, if you as a CEO are going to be here, if this is your prime market or your prime operations headquarters or whatever it is, then it might make sense for you to open a New York office, a US office, and then raise funds into that office. And that's something Gust can help you with. We can take foreign incorporated companies and bring them here and do stuff like that. So the answer is yes, you can raise here from a foreign company, but it only really makes sense if you're planning to do stuff here in the US as well as be here.
Awesome, thank you. Another question coming in around navigating being a founder from an underrepresented group. So we all know where VC money typically goes based on the reports. How do you see that bias playing out, and what advice do you have for overcoming what could be seen as a handicap?
So it's a good question. So for those who are familiar with this, there is an insane mismatch between the amount of money that goes to traditional white male founders and those who are non-traditional. It's not because investors are prejudiced, not because they're all racists, not because they say we don't invest in Black founders. And actually, in fact, it's the other way around. Virtually every investor venture fund I know of would love to invest in Black founders, but for various reasons, it doesn't work. And despite having now for several years said, oh, we really want to invest in non-traditional founders, the incidence of Black founders who received venture capital last year, 2022, was less than 1.2% of capital went to Black founders. This clearly is a problem. Since Black founders are clearly as capable as white founders of doing things, the system is broken. But the problem is nobody understands exactly how the system is broken, right? Is there likely some implicit bias, some pattern matching bias of the last six guys I invested in them, I made money, were happen to be white males, so that's what I'm looking for, or I'm looking for people who went to Stanford or whatever. Sure, there's some of that. Am I recruiting from my network, which happens to be people who look like me? Sure, there's some of that. But what investors will tell you is there's a very big pipeline problem. And that is that I just don't see Black founders pitching me to the extent that I see white founders pitching me. And when they pitch me, what they pitch me are businesses that may be great businesses, but the first kind I talked about, they may be healthcare or beauty care businesses, they may be neighborhood businesses. They're not the scalable businesses that venture capital goes for. So even if I wanted to, I couldn't invest. There is something between those two things, which is where the answer likely lies, right? There, no question, is a pipeline problem, right? I mean, I talk about this stuff a lot, but still the percentage of Black founders who pitch me is way less than white founders. And people are trying to do things proactively to work on that, the pipeline, but also looking at alternative funding sources. And so what we are doing at Gust, we are actually spearheading an industry-wide initiative called The Feed, which is designed specifically to help provide a technical basis underpinning changes in this industry that will make that work. I gave you the link before to my website, davidsrose.zealous.space. If you go there, there is a link to a video presentation that I've done about the feed, and you'll see what we're doing. And I would encourage anybody who's interested in this space to please come and click the link there, subscribe, and volunteer to work on it with us. We'll be spinning up a pilot version of it this summer, and hopefully that will be some really interesting and good things. One thing I would note, however, is that some of this change is happening better at the angel world than the VC world. The numbers for VC companies are staggeringly bad. However, the number for angel groups are really surprisingly good. So the demographics are that people of color are something on the order of 12 to 13% of the population of the U.S. Last year, according to the Angel Capital Association numbers, 18% of angel money went to Black founders. So they're actually punching above their weight. And since this whole thing about underrepresented founders came into play with female founders, 5-10 years ago, women founders were without question getting the short stick. First Round Capital did a remarkably powerful study showing that when they invested in female founders or management teams with females on them, they did better economically. And that helped people open their eyes and do that, to the point that last year, more angel funding went to women-founded businesses than male-founded businesses. So it's a little hard to say you're underrepresented in terms of angel financing if you're getting more than male funders, right? It's a very real issue. There's stuff we're doing to to combat it. But the first thing is to understand where the problem is. And, if in general, the business that you're doing is one that matches the investor's thesis that should be fundable, then there should be no reason why you don't get funded. And I think a lot of the match has to do with things other than blatant, prejudice out here. Read the thing on the feed, and please volunteer to help us with this problem.
Yeah, and I think this is a particularly interesting question. It's nice to see that there's some movement in the angel space, and hopefully that will push upstream. But I think it gives people a good idea of what a systemic problem actually looks like. Systemic problems are ones that are not easy to solve. They may be multi-generational problems. People who have been systematically, excluded from these things for generations haven't been multi-generational entrepreneurs, right? So when we talk about a pipeline problem, it's not just the number of people applying, it's the number of people who have been prepared to apply by the system that they have gotten to go through. So yeah, we are working on it. Please read the stuff. Please reach out. If you do have ideas, we are all ears. We would like to be a part of fixing it. Interesting next one, how to assess investor integrity.
Well, they're assessing your integrity, so you damn well better be assessing their integrity, right? So the best thing to do is look at their track record, talk to people in whom they invested. If any investor will not tell you companies which they've invested, will not give you reference contacts to their former portfolio companies, run, do not walk. There is none of this bullshit about, oh, I can't tell you who, I've invested in all these unicorns, but I can't tell you who they are. Sorry, any investor who is a legitimate investor will be happy to give you the names of references of people in whom they've invested, good or bad. Well, once it succeeded and once it failed, so you can talk to them. Do your homework, do your reference checks, and of course, check them out online and ask people you know in common.
All right, I think we can get through the rest. I'm going to do 4 more. Question, what about the people I've seen that have apparently raised capital without traction?
Forget all that stuff. Take everything you've seen, put it in a cocked hat and kick it out the window, right? I mean, nobody can know what is actually happening with those things. Every time you see one of these stories, oh, somebody met somebody on the subway and did a one-pitch thing and got $10 million check in here. No, it doesn't work that way, right? VCs are not crazy people. Angels are not crazy people. We spend a lot of time thinking about this, right? And when any time you see that kind of an overnight success story, there is much, much more under the hood. It's something that exactly fits their thesis. They know somebody who knows somebody. They've been looking at the field for a while. They've been tracking this company. They did research. There's all kinds of other stuff. There are terms to the deal that you don't know about. There are home run warrants. There are valuations. There are milestones to have to be hit. There are 16 million ways in which it's not what you saw. You can assume and take it to the bank that any deal that you see discussed publicly, whatever you see, is not the actual story.
Awesome. And let's see. Next up, how do I get opinions on my idea before I know I should keep building?
That's a really interesting question. There was an interesting website done by one of the credit card companies a while ago called Idea Blob, where people would put out ideas and other people would just rank them. And I always thought there was a need for that. There are, a lot of sites, there are a lot of forums. I would, things like this is, this is really a sort of one-way Q&A thing. But on Clubhouse, where I do a bunch of mentoring on Clubhouse, there are pitch rooms, there are how to pitch rooms on Clubhouse where people, will listen to you for 5 minutes and give you their immediate reaction. So join. So if you ask me for one suggestion right now, go to Clubhouse if you're not already on it, join the pitch club, look at I think they typically have 3 or 4 pitch sessions a week. These typically run 3, 4, 5 hours. Anybody who wants to can, take 5 minutes and give their pitch, and there are typically investors and other advisors listening to it, and they'll give you honest, legit feedback. And I think this, interesting idea, but you're not ready yet, or I think this idea really doesn't work for these reasons, and so on and so forth. So that's a good place.
Yeah, I think our friend Gil Silberman has a good perspective on this too. And he looks at it in terms of what are the fundamental risks to this business being successful. And I think you can eliminate or mitigate a whole bunch of those before you actually start building something. And it has from a technical background myself, this is a mistake we often see, that the first step is to go out and build what you think the market wants, when really the first step is to go ask the market what it wants. You can do advertising experiments on a variety of channels. You can go out and talk to potential customers. If you get people who are excited about this, who are willing to work on it with you, who want to sign on as advisors, who want to be a part of pushing this forward, you're getting some initial signal. If you can get initial customers, even better. You can get people on a wait list. Like, build the signal before you build the app. All right, and I will do one more because it's a very interesting one. Chris asks about the dynamic between angel investors and founders. His perception is that over the course of the last, I don't know, several years, maybe more, angels have been pushing more of the risk back onto entrepreneurs, and that the angel diligence process seems to have gotten more thorough. And is angel a misnomer now? Are we really playing with, tiny VCs? What is your perspective on how that has changed?
This is one of my hot button things over here. And so, all I can tell you is you've had an hour and a half now to calibrate me. So you know where I'm coming from, right? I think I am a fair statement over here. I am a serial founder myself. I regard myself as an entrepreneur. I call it like I see it. And I'm not pulling any punches, right? So that approach, which by the way, we hear from lots of founders, right, is coming from a very wrong place, right? The world is not inherently fair. We live in a capitalist Darwin society over here. And so nobody owes you anything. Angels, it's like people who say, why are doctors making so much money? Doctors should work for free. They're, why? Why should doctors work for free? They spend 17 friggin' years in medical school to do this kind of stuff. That's a job, right? Angels are doing this to make money. It's not your position to tell an angel that they should be an angel and give you money for this, that they should share the risk. The bottom line is, if you don't want them to have put the risk back on you, then don't take their money. Well, then great, good luck finding money. This is very much a capitalist society. Angels, there is nothing that says angels should take any particular amount of risk. It's not a question of being fair. This is what angels have always done. Actually, angel investing has gotten even more rational and less in the way of diligence than before. I can show you the diligence binders that I did for my company 30 years ago. It was literally this thick. And we tried, when we did the whole Gust deal room stuff, we reduced a whole lot of that down. So no, angels don't owe you anything. Angels are not charity cases where they're giving you money for the hell of it. They are business people like you who are making an investment. And just think, why aren't you making an investment in somebody else's company as an angel? Well, I don't have any money, or I need my money to pay my restaurant bill or whatever it is. Well, yeah, same thing with them too. So the answer is no. It's not a question of pushing risk there. In a capitalist free market society, if the returns, the rewards from investing and taking on more risk were worth the risk, people would do it. Nobody is saying you can or can't invest. You are saying, here's my company. The risk, you may not see the risk that investors see. Investors maybe have a little more experience with companies like yours and have a lot more time in grade. You may be completely convinced that you are the one exception, the 1 in 10 home run, and that's going to be the definitional Facebook for the next generation, which is great, and that's fine. You should have that passion to go ahead. But if an investor doesn't share that take, then they're not going to invest at a Facebook valuation, and to expect them to do so is frankly silly, right? If somebody out there in a relatively efficient system, and God knows the system isn't overly efficient now, but with things like Gust and Signal and accelerators and angel groups, it's getting much, believe me, it is 2 orders of magnitude more efficient than it was when I first started here. So we've had a lot of efficiency added in the system. And what that means is, if you start talking to 50 or 100 angels and you say, here's what I've got, and you get back people who say, well, I'll invest at a 5 million valuation with whatever it is on these terms, that is what the market is saying your valuation is. So there is no right to funding by anybody. Angels are doing this to make money. And if they are too risk averse and they don't want to do it, then somebody else who is more rationally risk averse will come in and do it, right? Often you'll have different angels, compete for a deal, not too often, but it happens. And so when you make the best case you can about why it fits their thesis. And if they say it doesn't, then take that and immediately say thank you very much and move on to someone else, and don't give it another thought, because the thesis is involving not only the market you're in, but the stage and the growth and the risk tolerance, and they have what it is. And so this is a free market economy. Keep that in mind.
And would you
So
say, obviously, this is
sorry to be so more adamant about this, but this is something you hear very frequently,
certainly.
and it comes down to markets.
But I think, right, all of this stuff is cyclical too. And as you've noted, like efficiency has moved primarily in one direction as the industry has evolved. But we think back to the original angel investor definition from Broadway shows, as I think you noted in your book. How do you see that kind of the outlook of angels has changed? Do you feel like less people now invest with an impact component when they're calling themselves angels? Or do you feel like it's more, or do you feel like it has always been, on top of the capitalist bent purely?
More, absolutely more. The idea of impact investing, other than a couple of groups that did it as their one little weird thing, like the Social Venture Network, which has been around for like 20 years, and Echoing Green and a couple of others who were only doing that kind of thing. Everybody else wasn't on their radar. Impact investing, which really began to come into play about 20 years ago, has now grown quite a bit. So there are groups like Tonic, which is an angel group, which only does impact stuff. There are venture funds like Acumen that invest in this. There are networks and all kinds of things. So you'll now see people doing it more. But again, if that's part of somebody's thesis, that's great. And then you can play to that, right? On the other hand, if it's not part of somebody's thesis, if they say, show me the money, I'm looking for the money, I don't care about impact, then you can be the world's most impactful company and it's not a match for their thesis. But also, by the way, note that there are two types of angel investors that I write about in the book. One of them is the financial first investor. You have to figure out which your lead donkey is here, right? You're either a financial first investor or an impact first investor. No such thing as being even. One's got to be, you got to aim for maximizing one with a cutoff from the other. And so if you're looking at a financial first thing, you're trying to maximize your return, economic return, but saying, I need at least this much social good here. That's the kind of impact investor I am, right? I mean, I won't invest in things that steal candy from babies or, do, gambling or, whatever, right? That's my sort of cutoff thing over there, but I try and maximize my returns. The other way is I want to have the most impact and I'm prepared to sub-optimize my returns, but I get at least a plan for at least a 5% return, if not a 25% return for what I'm doing. So make sure you understand where they're coming from.
Awesome. I think we can cut it there. Chris, thanks for ending us with a very interesting question to litigate. David, thank you so much for being here. Ryan, thank you for posting stuff in the chat. Everyone who attended, thanks for sticking around. A ton of you did, and this has been fantastic. Please keep up with us. We're doing a whole bunch more programming, as I said, over the next few months. We're here to help. Sign up for Gust, check out our social media, come talk to us at office hours, and keep coming to events, and hopefully we will turn you into better prepared founders.
You're here.
Thank you, David. See you,
Thanks,
everybody.
David. Thanks, Ryan. Thanks, everybody.